Hello, everybody. My name is Magnus Brandforce. I am a financial advisor with Steilacoom Investments. I'm the president of the company. I use Commonwealth Financial as my broker-dealer and National Financial Services, a wholly owned subsidiary of Fidelity Investments, as my clearing firm. I have been an investment advisor since 1992. Today's topic is post-COVID investing. Now what? So this is a bit of a follow-up to a video that I made in September called Surviving Turbulent Markets. And that video might be easier for you to understand today than it was at the time I published it. Because if you watch it now, there's hindsight. And you will see that in the absence of fear and uncertainty, that maybe it just makes more sense. So I really do encourage you to look at that, and it is a guide for what people need to do in surviving the next downturn. And it tells a little bit about how to avoid the risk of falling into the next downturn. So please do watch that video. So like the past, the scary market event wound up being relatively short-lived, and a properly diversified investment portfolio, and I do mean properly diversified investment portfolio, rewarded investors and brought them not just back up to where they were, but now we're making new highs yet again. So the real question is, well, all right, let's talk about, well, what happened? So we had a health crisis kick into an election year, which is normally problematic, along with political issues and an economic recession. The trigger event, of course, being COVID, which nobody could have predicted. So all of those events made the stock market have a decline, which bottomed out on about March 23rd of 2020. Down about, a properly diversified portfolio was down, 40%. And basically things bottomed out because there was just too much value at some point. And the dire predictions of millions upon millions of deaths in the United States did not occur. And government intervention kicked in with PPP loan for businesses and stimulus checks for taxpayers and, all sorts of, government freebies, helicopter money to, stop the bleeding. Then the election finally came and went, and lo and behold, we had a COVID vaccination, easing restrictions with the economy coming back, expectations of recovery, and declining numbers of illness and death. So in 6 months, we've seen now, since shortly before the election, as I mentioned in the Surviving Turbulent Markets, I said watch for about one-ish month before the election, that Wall Street and speculators and a lot of, maybe smart people don't want to have excessive or all their capital invested until a tumultuous event is either over or close to over. So a month before the election, and this happened in 2016, Wall Street waits, and then, okay, it looks like things are going to happen here, and then they put the money into the market. Well, and then all of those good things kind of came about. So all of the trouble and tumultuousness of the world, all of a sudden, within 60 days, started to dissipate. And that brought in a tidal wave of money, but also higher prices. They're not necessarily the same. In a healthy market, prices rise. That doesn't have to be monetarily driven. So all of a sudden, though, something else happened. We've seen market rotation. The leaders of the market for the last several years are not the leaders of the market for the last 6 months. So instead of tech and health leading the way, all of a sudden, energy stocks are leading the way. Retail, metal, industrial metals, small caps. So there's been this cyclical rotation and a relatively flat growth market. So again, leading the way, energy. And it's funny, Biden administration, we're labeled as the haters of energy, and you've probably seen the best stock market returns in the 6 months of history of energy under the Biden. As soon as Biden was elected. Oddly enough, under Obama, energy stocks really performed well, and I've said again that politics and the stock market aren't as closely connected as people think. So leading the way, energy, retail, financial stocks, consumer discretionary, industrial metals, and smaller companies. So retail obviously recovering for the fact that people have pent up needs for all sorts of retail items because they've been sitting at home for so long they haven't been shopping. That's good for retails and shopping malls. Financial stocks have been out of favor since the 2008 economic crisis. There are good things going on for financials right now, and certainly the stock market coming back up. Global financial has really taken off. Attractive area. I've been involved in that for a while. Automakers, less Tesla. Tesla's gone down, and all the other automakers are going up. Is Tesla an automaker? Is it a growth company or a tech company? I don't know. It's hard to say. It depends upon who you ask. So here we have the traditional blue chip dividend paying stocks and smaller companies doing well. Meanwhile, the NASDAQ, growth stocks, tech stocks, and the S&P 500 are flat. And in fact, for the first few months of this year here, right now, the S&P Growth Investor Index, which is a barometer of growth investors, is only up 1.39% year to date. Value investors, in many cases, are up 10%, maybe even 15% right now. So again, a cyclical rotation has happened over the last 6 months. It may be too early to tell, right now, where this is all going, but on the early end of it here, it looks like there has been a shift from growth stocks, which have led the market for 5, 6, 7 years. There's been a shift back to value. So a question is for somebody that is an investor in cash or they're in growth right now is did they miss the boat? Well, historically that wouldn't be the case. Historically, when there's a big cyclical rotation after a long period of dominance from one or the other, this is likely to be possibly a longer term trend, though the big money was made very quickly. So the change may very well be happening. I wouldn't expect the last 6 months of return probably are just not going to be repeated too much longer, but they may outperform. Now, does that mean that growth and tech stocks are dead? So, growth and tech stocks, healthcare stocks, they have very high valuations. There was a secular bull market for tech stocks last year as people stayed at home, bought computers, corporations, nonprofits, schools, individuals were buying computer peripherals, software to redesign the way they do business or schooling or personal finance. And so there was this surge, a secular one. It was the only part of the economy that was really booming, along with healthcare because of COVID, in certain sectors of healthcare. So it led to high stock prices and high valuations. And right now, there seems to be people maybe taking profits in it, reallocating towards value. Perhaps there will be a decline here in the post-COVID area because, what happens after everyone buys brand new stuff? It takes a few years before they have an appetite for replacing it. That happened in the dot-com bubble. On January 1st of the year 2000, every business, nonprofit, school, corporation, individual had brand new computer equipment. They didn't need that stuff for 3 or 4 years. So in March of 2000, when the analysts talked to the tech companies, they were told that business was unusually weak. And so tech stocks had a massive decline because business had dried up. And it would take until 2013 before the next bubble would start. So, it's probably, again, it's probably a little too early to tell. And you might say, well, hey, what about the really good tech stocks? What about these new innovative companies? Won't they be insulated from this? And, in the dot-com bubble, the downturn was so strong and so powerful that it took the good companies along with the bad companies. You can look at the financial numbers of many of the prominent tech companies of the late 90s that are still here today, and they did just fine business-wise in 2000, 2001, 2002, 2003, 4, 5, 6, 7, 8, 9. Didn't matter. Stock prices went down. Business conditions continued to do very well. It was a shift of valuations. Microsoft went from a stock that had a PE ratio to traditionally of 35-ish times earnings down to 10 or 12. Today again, Microsoft trades at 35 times earnings. In 2013, 2012, Microsoft had a 4% dividend yield because the stock price was so low. Today it's less than 1%. So in a serious shift, they throw the baby out with the bathwater. So, but then again, right now I am very skewed towards value. At what point for my clients at this point? In 2003, I waited 3 years to buy tech stocks, thinking I was smart and having allowed things to fully turn down. And I was right. So when I bought those things, they were indeed cheap, but it would take 10 more years before they really started going up again. They turned into value stocks. They were called value stocks. They were mocked. But eventually in 2013, a new growth spurt and a market would bring these stocks back up again into high favor. So anyway, last year was a particularly tough year as a value professional. I walked into 2020 as a very defensive investor in late 2019, knowing that an election was coming and anticipating trouble. I made what I thought were very conservative moves. Little did I know that the whole world would become rather chaotic. And surprisingly enough, the stocks that would be rewarded weren't the conservative ones. It would be the speculative ones. It'd be the growth ones. But that's the market. And that's one of the things that makes my occupation fun, is that it is sometimes rather unpredictable on the short term. So another interesting thing is, in the last 6 months, we have seen growth in tech for a 3-year rolling period was the only game in town, and it was primarily domestic. There was very little to be made for the last 3 years overseas, emerging markets. The only game in town was NASDAQ tech, growth stocks, certainly not value stocks. And in 6 months, there has been such a market rotation right now that all of a sudden domestic value stocks have a very impressive, if not better, return than growth stocks over the last 3 years. Meanwhile, internationally, things are recovering, not quite to the degree of domestic value and domestic small cap. And so that's an area that looks interesting. So what am I looking for this year and in the shorter term? I hate to make short-term predictions, but there are things that I am looking at. The last 6 months has been meteoric in the positive areas I've mentioned. That can't continue forever. And there comes a point where the returns become so excessive that perhaps in a few more months, I may simply feel the need to take money off the table and reallocate it. The question is, what are the alternatives? I mean, fixed income right now is priced so high, it's literally priced the highest it's been in basically 100 years. We have extremely low interest rates, and we have potential downside risk to fixed income that grossly exceeds any potential gains that fixed income may have. Very few people would play a game in Las Vegas where you stand to lose significantly more than you could possibly make in any one given bet. So fixed income right now looks rather troublesome. Real estate, there are pockets of real estate that are grossly overvalued, and there are pockets of real estate that look rather interesting right now. And then also global markets, long underperforming. It doesn't matter if it's an emerging market or a developed economy, Asia, Latin America, Europe. The United States right now has led market performance now for a very long time, and it's rather unusual because this is now a very developed economy, and valuations now here are high, and in many other places they're lower. So I am keeping a close eye on global markets. I have been fairly heavily allocated towards global markets now for at least a couple of years, and I feel comfortable with that. And the returns have been relatively good for the last 6 months. Not quite as eye-popping as some of the other leaders right now in the value segment. So this year, I'll tell you right now, and it's a no-brainer. The second quarter of this year, April, May, and June, when those economic numbers come in, they are going to be blowout. They are going to be ballyhooed by the media and the politicians of every given city, state, local government, federal government, international community, whatever, because everyone loves winter. But it's like shooting fish in a barrel. Last year, April, May, and June were terrible, so this year you'd expect them to be fantastic. And it's one of the reasons why many of these stocks are going way higher. But, you know, the euphoria is going to be there, along with the fact that people are going to be healthier. We're leaving the normal cold and flu season anyway. But so there's going to be sunshine, there's going to be flowers, people back to school, graduations in college and high schools, and a resurging economy and a flying stock market. Everyone's going to be happy. There's not going to be any losers. So this will step itself back into the market again. So it'll be baked into the cake now a second time. Like I said, it's already baked into the cake. People already anticipate a strong economic recovery, and that's why so many of these stocks and industry groups are moving much higher. But that is kind of the way the market works. Eventually, the good news might be baked into the cake 3 or even 4 times before the party comes to an end. So someday this party will end. There will be so much euphoria baked into this thing that the only thing left is the question of, well, what about balanced budgets? You know, what about higher taxes? What about inflation? What about the need for raising interest rates from, you know, unusually and unrealistically low rates? But you know, I don't think that's what we're going to see this year. Perhaps not even next year. So until then, it appears to be time to eat cake. So I hope you enjoyed this video segment, and if you're a client of mine, I want to thank you so much for your patience and understanding during an incredibly tough year last year, and the rewards that you've been paid in the last 6 months are very well earned by you. And if you're happy with this video and you like it, please subscribe to my channel and forward the video to somebody that you think might benefit from it. So until next time, many happy returns.